Hello, hi. I'm going to discuss chapter 13 from Loftus textbook. It's about share capital and reserve. I'm going to explain few things what is shares, preference shares, options, how this thing being recorded, and the process involved relating to the issuance of shares. So I'm going to spend first hour to cover part of this content, and then going to do one question, maybe 13.12, and then I'm going to go back. I'm going to finish the lecture. So let us start with what we're going to cover this morning. Yeah. Number one, I'm going to explain the equity of a sole proprietor, partnership, and company. This is just a revision what you have learned before during your EK 112 and EK 200. Number two, identify the different form of corporate entities. For companies, they have different type of companies. They have limited, unlimited, yeah. So many type of companies depend on countries, yeah, depend on countries. Some countries they might only have limited, unlimited, but some countries they have more variation of the companies. Okay. Number three, how about the corporate structure? What are the key features of the corporate structure? Okay. Number four, I'm going to explain the nature of share capital and different types of shares. We have ordinary shares capital, then we have preference shares, yeah, and preference shares also can be divided into several types of preference shares, yeah. In certain country, for example, China, or maybe in Australia as well, when we talk about the ordinary shares, they have these ordinary shares type A, type B, type C, but not in Malaysia. In Malaysia, we only have ordinary shares, one single type of ordinary shares there. But in certain country, they have different types of ordinary shares. Okay, and then I'm going to show you how to use the initial issue of share, how to account for that, what are the journal entries, how to record that. We're going to do one exercise on this, and then discuss the nature of account for and issues of shares subsequent to the initial issues. Okay, the company issue shares. After that, maybe they have other ways, for example, bonus issue, right issues, dividend. So how we are going to account for these transactions? Discuss the rationale behind an accounting treatment of share buyback. What is share buyback? Share issue is when the company issues shares to the public, offer shares to the public or to the private groups that we are issuing new shares. So if we are inviting you to buy the shares, we're inviting the potential investors to buy the shares. So that is issuance of shares. For share buyback is where we invite the current shareholders to sell their shares back to the company. So our company shares will reduce. The number of unit will reduce. Okay. So that is share buyback. Why we have to do that? Yeah. Why the company choose to do share buyback? We're going to discuss that later on. Okay. Number 8, explain the nature of reserves and account for movement in reserve, including dividends. We did learn last semester or during EK 200, we have many kind of reserve. You have retained earnings, yeah. You have general reserve, asset revaluation surplus, maybe foreign currency translation reserve, and many kind of reserve. So how are we going to move the amount from one reserve account to another reserve account? Yeah. Or maybe we want to issue dividend to the shareholders. We have made profit. We have enough retained earnings. So we want to distribute the wealth to the shareholders. So how we're going to do that? How we're going to record the journal entries? So I'm going to show you on how to do that. And finally, not finally, yeah, prepare a statement of changes in equity, yeah, statement of changes in equity, as well as a note disclosure in relation to equity. We normally prepare income statement, statement of profit and loss and other comprehensive income, then statement of financial position, and another important statement is statement of changes in equity. We have opening balance of the equity and reserve, and then we have closing balance in between. In between is the movement plus minus. So by reporting that statement, it helps users, especially investors, to know what are the causes, what are the reasons of increase or decrease in their equity and reserve, maybe issuance of dividends, shares buyback, and so on. So let us start with equity. When we learn accounting, we still remember when you join my class or Miss Dr. Namrata or Dr. Munir class, during your EQ 111, we did discuss about asset is equal to liability plus equity. Asset is equal to liability plus equity. So that is the formula. Asset is equal to liability plus equity. I did mention what is asset. Asset is, when the economy, asset is when the company has, okay, economic resources, yeah, we have a right, we have control on that, that will give you benefits, future inflow of economic benefit to the business as a result of the past transaction. For example, cash, it gives you economic benefits. You have car, it gives you economic benefit. And then we define liability. Liability is obligation of the business, okay, as a result from the past transaction. You borrow money from banks, for example, so that is liability. And then we define equity as the net worth or the difference between asset and liability. Equity is equal to assets minus liability. So that is what we have been doing during our AQ 111. So equity basically is a component of statement of financial position, or student normally call it as a balance sheet, component of balance sheet. With a sole proprietor, having a single owner mean there is a little reason to distinguish between capital and profit. When we did our EQ 111, we only have one item, equity. Am I right? Equity, that is opening capital plus profit minus drawing. So that is your equity when you do your AK11, because we are handling a sole proprietorship. One owner start the business, he run the business, he's the sole owner. For partnership, we have different types. We can have with a current accounts, or just the capital account. So we have partners. When in this partnership, we have maybe partner A and partner B. So we need to maintain maybe their capital accounts, and sometimes we can also have the current accounts. The current accounts. Okay. For company, the situation is a bit different because their formation is generally governed by legislation. There must be a Corporation Act. For certain country like Australia, they have Corporation Act, and other country they have their Companies Act. Okay, and this is normally a clear distinction made between the contributed capital and profit retained in the entity. So we want to maintain, when we have this corporation, we want to maintain what is our capital contributed by the shareholders or equity holders. Another one, we want to maintain the profit. The profit is generated from the operations. This is from operations. So we started to distinguish between capital result in issuance of shares or shares buyback or whatever related to the shareholders, with another part reserve or profit resulted from the operation of the business. So we are not combining our accounts like what we did during our AK 111. We combine capital plus profit minus drawing give you ending equity. So we don't do that for AK for company. But we're going to distinguish between capital and reserve. Are you okay for the time being? Let us move to different types of companies. Okay, when you have companies can be distinguished by the nature of ownership, and number one is by the right and responsibility of the shareholders. Okay, so we have company established for profit company. Okay. Another one is not for profit companies. Okay. But most of the company established under this category. Yeah. To make profit. But there are also instances, certain organization they form companies, but they don't meant for making profit. Maybe they raise income or donations to have certain for certain programs or to have certain group of unfortunate people or certain agenda such as campaign or awareness on environment. So they have different companies on that. But most of the company I can see 99%, 95% are for profits. For not for profit company, okay, so it's not defined under IFRS, okay, but AASB number 102, the Australian Accounting Standard Board number 102, inventory say a not for profit entity is defined as an entity whose principal objective is not for the generation of the profit. Yeah, this is the definition. Very easy. What is the not for profit entity? Company or corporation established with the objective not to make profit. For profit company can be divided into government or public sector company. The government established the company. Okay. Another one is the private not for profit company. Government. We have several layer of government. Yeah. Several layer of government. Yeah. For example, we have the federal government. We have the state governments, and maybe we have municipal government. In Australia, they have this different government because this very big country. So they have this region or territory. They have, for example, Western Australia. Okay, then we have this South Australia. Then they have Queensland, New South Wales. That is the territory or region. Yeah, for the government. Okay, for-profit company may take number of form as follows. Number one, proprietary company or close corporation may establish with limited membership, only limited membership, and restricted on obtaining fund from the public. So they have limited membership. Maybe they form this company among and the shareholders come from the family members. So limited number. It's not open to public. Another one, or maybe their colleagues, yeah. Second is the public companies or open corporation. Anybody, anybody, yeah. You don't need to fulfill certain criteria or know someone to be the members, to be the shareholders of this company. So this is called a public company or open corporation. Generally have a large number of issued shares with the ownership being widespread. So this is, for example, Google. Our building, the opposite of our building is the Google building. Can you buy Google shares? Yes, you can buy the Google shares. It is traded at the stock market. Yeah. How about Cisco? Yeah, or Facebook shares. Can you buy that? Companies shares? Certainly yes. There's a public company. It's available. It's available at the stock market. You can buy the shares at reasonable or at the current price. Okay. For profit company, it can be either listed, listed means traded at the stock market, stock exchange, unlisted, limited by share, this is limited by share, limited by guarantee, unlimited, or no liability companies. No liability means the company without any debts. Okay. So the choice of company as a preferred form of organization structure bring with it certain advantage such as limited liability for shareholders. What is limited liability for shareholders? If you are the investors, if you are the shareholders, you own shares worth 10,000 dirham. 10,000 dirham. Okay. So your liability, your loss is limited to 10,000 dirham only. So that is what we call as limited liability for shareholders. If the company run and suddenly because of the COVID, it failed to pay its debt, it failed to generate any incomes, so the third party, the creditors, can only go for the existing shareholders. For example, if your shares is 10,000, so that is the amount of losses you will suffer because of the COVID, because of the failure in the operation. They won't ask you to fork, to give more money to pay the creditors. Yeah. So some the disadvantages, such as making the entity subject to greater government regulation, including for the forced and detailed disclosure of information about it. So this is the common situation in every country, whereby the country, the government will establish the Companies Act. It will detail out what kind of information need to be disclosed. Yeah, and the stock market also is a regulatory agency whereby they will force company that listed on the stock market for certain information disclosure report. For example, under the Companies Act or Corporation Act, you need to file the financial statement once a year. Once a year, only once a year. Once for every financial year. But if the company traded on the stock market, you have to do it every quarter. Every quarter, you have to send your financial statement. So that is what we call as additional disclosure requirement for listed companies. Okay, the use of share capital, beside the right to share equally in the net assets, the profit and loss of a company, each shareholders has the right, including the following. Number one is the right to vote for directors of a company. Okay, every year, the company will have meeting, call it as AGM, annual general meeting. Annual general meeting. So all shareholders are invited. All shareholders are invited to the meeting. Yeah. In the meeting room, can you imagine the big room they have? Yeah. They will appoint the new directors that will be the representative for the shareholders. So every shares, if you have one shares, you have one voting right. Normally, that is the normal situations. Yeah. So the more shares you have, the more voting rights. So in order to control the company, you must have the maximum shares available, maybe the majority of shares, yeah, for those who attend. So the right to vote for directors of directors. So you can choose the directors. Okay, maybe the company have 7 directors. This is called as the board of directors. So you need to appoint the 7 directors. They will sit on this board of directors, and they will decide the direction, the strategic direction of the company, where the company want to do, what kind of investment the company want to do. They will appoint the board of directors, will appoint the CEO and the top management. The CEO, CFO, they will appoint the top management of the company. The board of directors, they don't do the exact daily or manage the business activities. They'll appoint another managers. Yeah, they call it as CEO or general managers to run the business. So that is the right of the shareholders, the right to vote for directors. Number two is the right to share in assets on the winding up or liquidation of the company in case of bankruptcy or liquidations. If after this is the amount of money, maybe you have 500 million, pay all the debt. We have many debt, long-term debt, we have mortgage, creditors, the utility companies, maybe you pay 350 million. So the balance here, 150 is the amount left, the residual amount. So this residual amount will be distributed to the shareholders. You might get less, then this 150 million will be distributed by the shareholders. So the shareholders has the right in asset of the winding up or liquidation of the company. Okay. For example, if the shareholders here have 10,000 shares, here is 20,000 shares. So the shareholders B might have a higher portion of this 150 million. So from the total shareholders, maybe they have, I'm not sure, 300 million shares. So if you have 10,000, so 10,000 divided by 300 million multiplied by 150 million. So that is the amount you're going to receive. The right to shares proportionately in a new issue of shares of the same class. If the company issue new shares, the right issue, the right issue, so you have a right to buy the shares. Okay. For example, I'll give you an example. Okay. The company want to raise money. So what they offer is offer to buy, not to buy, to buy one share, one new share for every five shares held. held. So if you have five shares, you are being offered to buy one new shares. If you have 10, so you got you have a right to buy two new shares. Maybe this is at discount, as discounted price. So this is the right issue, right to buy shares. Right to buy shares. So you have a right to vote, right on asset in case of liquidations, and number three is right to buy the shares in during for the right issue announcements. Next, limited liability. The liability of each shareholders is limited to the price of shares at the times of issue. Next is the feature of limited liability protects shareholders by limiting the contribution required of them, which in turn places a limited limitation on the ability of creditor to access fund for payment of the company debt. So this is what I explained for limited liability company. So the liability of shareholders is limited to the amount of shares that the company issue. I give you example. This is the shareholders. The shareholders shares gift 100 millions. Okay, to the company. Okay, are you okay? This shareholders investment is 100 million. Suddenly the company is making losses and have borrowed money. Loan, yeah. Loan now is higher, much higher. Loan now is 120 million. Okay. So after taking all the assets here was 100 millions, yeah, they still don't have 20 millions, insufficient 20 millions. So this 20 million, you cannot, the loan holder cannot ask the shareholder to pay. Why? Because their liability is up to the 100 million. So this will be the loss for the loan holder. Loss for the loan holder. par value and no par value shares. The par value does not represent a fair or market value of the share. What is the par value? The basic value. Normally is $1 or 1 dirham. Yeah, yeah, that is the standard unit. So every shares unit is $1 per share, for example. This is just an example. But at the stock market, it can be higher or lower than that. The stock market is the fair or the market value. The only real purpose of the fair value is to establish the maximum liability of the shareholders in relation to the company. What it means, if A bought, okay, 10,000 shares at price of the par value is $1, so a liability is only 10,000. Not a liability, A's, their responsibility is only, or liability I can say, is only 10,000. In case of bankruptcy, okay, if A have not paid the 10,000, so he only has to pay this amount 10,000. If A already paid the 10,000, so he cannot be asked to for more money. So this is the maximum liability of the shareholders in relation to the company. So the key variable of interest are then the number of share issued and the amount of share capital in total. Yeah, the number of share and the amount of share capital in total. Yeah. Ordinary shares, we have different types of share capital. The most common one is ordinary shares. In US, they call it common shares, common stock. Ordinary share is the most common form of share capital. Many ordinary share issues require investor to make full payment. If you want to buy the shares, you must make the full payment for the share upfront. We're going to do this, yeah? Okay, when they issue the prospectus is a document or advertisement calling for investment. So as new investor, you need to fill in the form, maybe electronically, or last time they used paper. And then when they submit their application to buy the shares, they have to attach the check or the payment or transfer the money. So that is what it means by make a full payment for the shares upfront. That's just example. But in certain cases, we can find maybe they only need to pay certain percentage, maybe 50% or 40% when they make the application. Later on will be paid when the company call for payment. So when they call for payment, for example, one share is just put $5. The price $5 is for per share. So in the first example, if you want to buy 10,000 unit, then you're going to multiply by $5. So that costs you 50,000. That costs you 50,000. But in certain cases, in other cases, okay, maybe they ask you to pay 40% when you submit your application. Another 40%, okay, this is your call number one, and 20% call number two. So you have to make three payments. Okay. If you want to buy 10,000 unit at price of $5, so it's going to be 10,000 times $5 multiplied by 40%. This will be the first one. That is 50 times 4, yeah, that will be 16,000. So the first one you pay 16,000, second one is also 16,000. When they approve you and they call for you, give you 1 month to pay another 40%, and finally is another 8,000. So this is the formula. Are you okay with this? Okay, pay lump sum, or you can pay in by different steps. Yeah, when you submit and when they make a call number one and call Number number. Okay. What are the returns to the shareholders? Why people buy shares? Why you want to buy shares? Because you don't want to put in your bank accounts because they only give you very little return. And you put to the bank, they give you little return, and you found that this company is growing, they're going to make a lot of money. So you want to buy the shares. Why? The reason. The question is why? Why? The reason is you expect certain return. If the shares make profit, normally they'll give you dividend. Dividend is a return to appreciate, to compensate, yeah, the amount given by the shareholders. So you want to please the shareholders by giving them dividend, okay? By giving them dividends. Sorry, by giving them dividends, okay? It can be in term of cash. It can be cash dividend. It can be shares dividend. What is shares dividend? They don't give you cash, but they give you shares. The number of shares you own increases. Yeah. Okay. So that is the return to the shareholder. But if your shares are traded at the Dubai stock market, Abu Dhabi stock market, New York stock exchange, yeah. So for this listed shares, the share prices might also goes up. If you buy the shares at price of $5 and then the shares goes up to $6, so you make a gain of $1. $1 is equivalent as capital gain. Capital gain. Increase in the value of shares. If you want to sell the shares, you can sell it at $6. So you make a gain of $1. $1 from $5. That is 20% return. Okay. Another type of share is preference shares. This is very popular. Okay. They don't have this voting right normally. Yeah. You call them to invest in your companies. Yeah. To give their money and you give them preference shares. Preference mean priority. Priority. Okay. Aditya. Preference mean priority. In terms of what? In terms of getting their dividends. They will get the dividend first before the common shareholders or ordinary shareholders get their dividend. So that is the preference shareholders or the priority. Okay. So we have cumulative versus non-cumulative, participating versus non-participating, convertible versus non-convertible, and also converting preference shares, redeemable versus non-redeemable. So these are all the characteristics of the shares. So you can combine these characteristics of shares as well. So let's go one by one. Maybe the cumulative, non-cumulative preference share. When you learn finance, you know this term cumulative, non-cumulative preference share. Let me just put here the number here, 6%. 6% preference share. What does it mean? Anyone have an idea about the 6% preference shares? In front of the name, we have 6% preference share. Anyone? The 6% refers to the annual dividend that the preference shareholders will receive. The annual dividends the preference shareholders will receive. So if you have 10,000, so you're going to receive 600 annually. So in case the company is making profit. If the company making loss, so there's no chance the company going to pay you preference dividend, correct? Dividends, preference dividend. So we will have cumulative versus non-cumulative. Okay, this is year 2020, 2019 before this. Yes, they paid you dividend 6%. 2020 because of the COVID, no business, so making loss, so 0% dividend. 2021, okay, okay, the business started already. So you pay dividend here 6%. How about this 0%? If your non-cumulative preference shares in year 2021, even though you make a lot of money here, you're not going to pay the previous year outstanding preference dividend. So you're not going to carry that one. Okay, that is non-cumulative. For cumulative, you're going to pay the 6% current year plus 6% previous unpaid preference dividend. So that is the difference. That is the difference. So you can read in detail what are the differences between these this type of preference dividend from your textbook.